this August 29th. This exclusive analysis is for Trading Capital and members and subscribers. Today we're going to be discussing the S&P 500, the Nasdaq, the Russell, gold, the dollar, and the interest rates still continuing to surge and put pressure on these markets. So jumping into the SPX, we're looking at the SPX chart because we usually look at the SPY. It's good to sometimes diverge because there are sometimes some very small differences in the SPY chart and the SPX chart. So looking at the SPX, you can clearly see Friday had a massive down candle which caused that technical damage on the charts. And today you followed by a gap down which has rallied off of the lows. You filled that gap, but now you've closed back off of the highs of the day. And as a technical analyst, what has transpired on this pattern is not good for the overall bullish market sentiment. Considering that you had a hard day on Friday, a sell-off day, breaking key supports and damaging key technical support areas over here, today was the day where you needed the bulls to kind of negate that action and save it, and they failed to do that. So today you're actually what looks to be 20 minutes left in the candle, what looks to be a confirmation of a failed breakdown move. So that being said, if this does close lower than this previous low, you have now confirmed the downtrend, and it does open up the probabilities, in my opinion, at least to this gap fill around the 39.16 level, and then eventually to this 37.89. But these markets are in dire straits, they're in trouble. Coming back into the September period where volume typically picks up, we also have, not only is volume and summer vacations coming to an end as the Labor Day weekend comes and approaches very quickly, you're also going to have the Federal Reserve starting their QT in maximum force, well, apparently starting their QT in maximum force. So withdrawing billions and billions and billions each month is certainly going to be a headwind for the markets as opposed to a tailwind, which is what we experienced for the last few trading sessions. Now, if we simply pull this parallel channel down a little bit, you can see you pretty much had to retrace back to the breakdown zone and failed to hold that area. I still like to use the closing lows over here, which shows that you have clearly damaged that support channel, and now you're trading inside of this original downtrend zone. I do think eventually we hit this level, you'll probably get a decent bounce off of that level. It's just a matter of how much of a bounce are we going to get. But overall, these markets are still in trouble on a technical basis. We have not changed our stance. We are still net short the markets. We did cover a few winners today. We issued some day trade winners. We covered our STM for a beautiful double-digit gain. So congratulations if you took those trades. We also covered our SOXS. That's our 3 times semiconductor shorts. So we banked a beautiful 14% there. So continuing to bank profits. Yet again, our swing trading account is up, new highs, as we continue to see this market grind lower. And on a technical basis, I am going to put my neck out there and say I think we're going to get a breakdown pretty quickly here over the coming weeks that will catch a lot of people off guard just due to the damage that I'm seeing on the charts, as well as comparing some intermarket analysis of different sectors and what that typically means and in terms of strong correlations. Let's take a look at the QQQ. So the Nasdaq has been under pressure. Let me just erase all of these so we can start fresh. So overall, the Nasdaq again had that nasty sell-off on Friday. You're getting a confirmed downtrend breakdown. So again, more downside for the Nasdaq is very likely. You are holding this purple moving average, which is the 50-day moving average. So there is some sort of support. The next downside level I have for the Nasdaq is around this 294 and change. You have several support areas in and around this range. So I do think we get a bounce if we hit this level. It's just which level is going to be the most robust bounce and how deep do we go. So you can see there's about 4 support levels pretty much in a very tight range. So we may not really get a decent bounce off of the first 2, but if we hit these last 2, we should get some sort of a robust bounce, at least for maybe a day or 2 or a week. So let's continue to watch those levels, but the overall level to beat for the Nasdaq is if you just draw a trend line down there, you can clearly see that we had that initial breakout of this downsloping resistance, which basically failed on a weekly basis. So you can see that we had that weekly breakout. You wanted confirmation, but you failed, and now it looks to be that you're going to head to the lower end of the range. If we simply want to find out where the lower end of the range is, we draw a trend line all the way down there, and you can see that it's a pretty long way down, which should coincide with perhaps the previous COVID high. I do think potentially by the end of the year we could see the Nasdaq down at this COVID high or pre-COVID high before things got really nasty. So that's kind of what I'm expecting. Obviously it's not going to be a straight shot down. You will have multiple weak bounces along the way, but don't underestimate the power of these downtrends, especially as the markets start to pick back up, in the sense that volume will likely increase. Looking at WTI oil is slowly approaching our first short level. You can see you had a little bit of a bullish consolidation. You've had a breakout today. Closing above the 50-day moving average would be technically short-term bullish, which does favor more upside. I'm still comfortable potentially accumulating a short here if we go straight into it. If we see a couple days of consolidation, I may have to readjust our level higher before I'm comfortable accumulating the SCO. Natural gas is pretty much just flat on the session, down slightly. You can see you're forming a little bit of consolidation, but ultimately I still think this is going to head lower, being the fact that this topping tail is still technically valid and intact. You've now failed on 1, 2, 3, 4, 5, 6, 7, 8, 9 trading sessions before you failed on 9 trading sessions to get a confirmation. The longer you fail a confirmation and confirming a breakout, the more likely it is that that price action is to head lower, and I certainly think that natural gas is still extended. I think we head to the 650 area, 630 area before we see some sort of a robust bounce off of that level. Let's take a look at gold, shall we? Oh yeah, and just touching on the spider volume. The spider volume today on the SPY is about 56 million, so it's not as heavy as the Friday sell-off, but it is starting to pick up a little bit more compared to your summer doldrum levels. Gold is still technically at support. It is having a little bit of a down day today, but it has rallied substantially off the lows, actually closing pretty much just flat right now in the session. So again, the fact that it is at support, you have to naturally respect that. I think gold's number one problem is the US dollar. You can clearly see that the US dollar has put in this daily topping tail. Now, generally daily topping tails do give a strong signal that the potential top can be in. However, I'm a little bit suspect of this topping tail on the DXY. Reason being is that this was your original top. You had this massive move down, strong rally up right into resistance. You pulled off of that resistance. Double tops are notoriously strong for acting as resistance, which you had a little bit of a pull off, but the dollar has just been so strong on the back of interest rates soaring that you had this beautiful reversal hammer candle now here, and I do think that this hammer candle, this reversal hammer candle, is going to be stronger than this topping tail. So I do think there's actually going to be more upside in the dollar, and I don't think this is going to be the top yet again, because you would have expected that resistance was weakened since you tagged it here, almost tagged it here again, consolidated for a few days, and now you've come up and actually pierced it and broke it, have not closed above it, but you have weakened that level once again, which does, in my opinion, point to a little bit more upside in the dollar, which should again start to put more pressure on equities. In terms of upside for the dollar, you can see I am watching this parallel channel where it connects to pivot high, pivot lows, pivot lows, pivot lows. That's going to be a key area for me. If we get a float up to above 110, 111, that's going to be a tremendous amount of pressure on the overall equity market, commodities, and so on and so forth. And honestly, with the way that interest rates are surging, let's just take a look at the US 10-year yield. Oh, let me just type that in, right? So if we look at the US 10-year yield, it is up again today, up another 2%. So you can clearly see you're into a little bit of resistance, this pivot high to this pivot high. If we flip to the weekly basis, there is, you've had 3 weeks of upside. So some more consolidation would be ideal to see if you were bullish on yields continuing to rise. So far, this is a little bit of a bullish consolidation sideways pattern that is forming. So if this sideways pattern continues to hold, the longer it consolidates, yields do have a favor of potentially continuing to spike up, and which will obviously put pressure on the overall equity and especially the Nasdaq tech heavy sector. Let's touch base on Bitcoin as well, considering that it has had some interesting price action. on the weekend. So BTC USD. So Bitcoin actually broke the key parallel channel that we were watching, and you can clearly see that the bear flag has now been triggered on a technical basis since you broke it and confirmed with 2 additional down days. Bitcoin has had a nice robust pop today, up 2.8%, pulling back slightly off the highs. But again, you're at this yellow line, which if we flip to the weekly basis, this yellow line is your pre-2017 high. So that is a big pivotal area. If we lose this 2017 high, which we're on the verge of doing so, then you're likely heading back down to this support range around the 13,000 to 10,000 area, and that will be your next major level. But we saw how fast Bitcoin sells when the momentum to the downside occurs, and now you have this weekly bear flag pattern inside of another intermediate bear flag pattern inside of another minor bear flag pattern. So bearish patterns are formed and have triggered on all 3 time frames for Bitcoin, which does point to about an 80% plus likelihood of us seeing more downside in the near term. And once we take out this pivot, you'll likely see the stops starting to be run, and you'll start to see that waterfall sell-off start to occur in Bitcoin again. If you flip to the weekly basis on Bitcoin, you can clearly see you had 1, 2, 3, 4, 5, 6, 7, 8, 9 weeks. You finally broke down below the weekly 200 moving average, confirmed with another week last week, and now you've started your new week. And the question is, what type of pattern is this going to be? Are we going to get more selling right away with the equity markets? But I do think Bitcoin is going to be the leading indicator for the markets, just due to the fact that it has triggered on all 3, the minor, the intermediate, and the major time frame bearish patterns, which points to much lower price. So I'm just staying put for crypto. I'm not prepared to short it, even despite the massive technical signals pointing towards more likely downside pressure. But that being said, if it were to pop, it didn't quite get to our short level around 25,000, this pivot. It was very close, but I'm not prepared to chase Bitcoin since it has fallen over the last few weeks, down from 25 all the way down to basically 19.5. That's a pretty substantial drop. So let's continue to monitor the price action. Overall, there is going to be tons of opportunities as things progress, and as these markets head lower, you'll continue to see our accounts fly in the right direction as the markets get decimated one more time. Let's take a look at the semiconductors, because that is a leading indicator. The SMH, a little bit of a messy chart. Let me just remove that. You can clearly see the SMH has rolled over. If you simply do a little bit of a pattern analysis here, you can see you have this left shoulder ahead, this right shoulder, you triggered it, and now this head and shoulders pattern has triggered. The downside likely takes you to about, let me just figure this out, likely takes you to about here. So you still have a little bit more downside before you get some sort of a likely technical bounce on the semis, but the semis typically lead the sectors higher and lower. If we look at how the sectors performed today, XLF was down, energy was up, builders were down, industrials were down, consumer staples were down, utilities were up, which is interesting to note. Typically utilities see more of that defensive money flow. So typically when you see utilities rallying as the rest of the market is falling, that's never a good sign, because it does show that when utilities do top and money flow stops flowing into utilities, that means a harder sell generally occurs in the markets. Healthcare was down. That's also another defensive sector, so that's never a good thing to see, as money rotating into predominantly cash. Real estate was down. Consumer discretionary was down. Technology was clearly down, communications down, and the 2 big things, which is why I'm so confident that these markets are heading lower. The DJT, the Dow Jones Industrial Transport, has confirmed the downtrend from Friday's breakdown. So you've had confirmation of a down day and a confirmed downtrend, and then you also had a secondary confirmation from the broker dealers. So typically you see broker dealers rally first to lift the markets, but now since you're seeing broker dealers rallying and falling over, as you got confirmation from the Dow, those 2 are pretty much your most important sectors that are going to be the likely confirmation and confirming this downtrend. Not only did you also have the Dow Jones and the XBD down, but again, lumber is consolidating bearishly and showing a tremendous amount of weakness as it's trading at these short-term lows over here. So it's never a good sign if you're a bull to see the Dow Jones confirm a downtrend along with the XPD confirming a downtrend on the same day. So really not much in terms of strength out there. It was another hard sell-off today, not as hard as Friday, but again, lots of bearish patterns forming. Some stocks are still hitting up highs. We did add a new trade today, not as hard as Friday, but again, lots of bearish patterns forming. Some stocks are still hitting up highs. We did add a new trade today, our COP, ConocoPhillips. One of the reasons I add that is because I do think oil's near a short-term top, or at least approaching. But COP has had a tremendous rally. And if you simply take a look at this move from this low to this low, and then you take this low to this low, you've pretty much had a near measured move, picture perfect symmetrical move. Even when you look at the pattern formation, you had this rally, a little bit of a consolidation, boom, pop. You've had this initial first rally, consolidation, pop. So you've had pretty much an identical symmetrical move when you take this low to this high, this low to this high. And you're also into a massive technical gap fill area, which is why we accumulated the short, as well as the 786 retrace zone. So tons of technical factors at that trade. You accompany that with oil potentially starting to hit some near-term resistance, as well as natural gas. The likes of some of these energy companies will likely see some downside. XLE as well as another interesting one is that you had this distribution signal occur on Friday. Looked like you were going to rally and close above it, but you failed to hold the highs of the day. Despite XLE being up, XLE is approaching the top end of this resistance channel. There is a gap fill here, which I'm still eyeing up for XLE, but whether or not we get there in the next week or two still stands to suggest that we could get there. But overall, XLE is getting short-term extended, and I do think it's a matter of time before we start to see those energy plays and those energy shorts once again start to decline, especially as the major S&P 500 and the equity markets really start to price in the QT, which is inevitably going to drive us into a deep, deep recession, considering the Fed is always behind the curve. Let's take a look at the US 20-year yield because we're still basically picking up bonds. So again, the 20-year yield is showing a little bit more weakness, which means the long end bonds should start to pay us out faster than the short end bonds. So this is why we're accumulating the long end bonds like UBT, which is the 20-year leverage play. Overall, I am starting to see massive topping formations in the long end of the curve. You can simply see by this inside bar topping tail, you've had now multiple weeks of trading all stuck within this wick over here and this body over here. Pretty much all of your price action has been stuck inside of this bearish reversal candle. So what that tells me is that we have seen a likely top in the long end bond yields. So that being said, accumulating this UBT, the 20-year treasury, I think is a very, very smart decision, especially if the markets do start to unfold and fall a lot faster than, let's say, the Federal Reserve is anticipating. So if credit yields start to explode out, then we'll start to see a Federal Reserve that will adjust. I don't think they're ready to adjust yet. God knows that if they start to pivot too soon, it's going to be a big disaster, and their credibility will be out the window, and certainly inflation would not be coming down. But overall, I do think that the topping signals are starting to form on the long end yields. The short end yields are a little bit different just due to the curve being inverted, and the damage is basically accumulating day by day as the yield curve is still inverted. But overall, again, a nasty down day. The NASDAQ is down 0.98%. Let's just take a look at the SPX. So the SPX was down today 0.67%. So overall, if the market did not have strong energy to muster up somewhat of some buying power in the indexes, we could have seen another bloodbath occur on Monday. But the bears kind of still won the day today, confirming the downtrend across multiple sectors, as well as yields starting to outperform again. So let's continue to see how fast these markets can fall. But again, you don't want to be holding long positions as these markets fall, because these markets can fall precipitously, and that's certainly what we saw over here in March, April, May period. We also saw it here in June period. So you do get these small technical bounces at key levels, but by no means yet are we at strong, convincing technical levels that will produce a robust bounce or a bounce worth anything going long for. So that being said, let's keep our trades nimble, and let's keep analyzing the market connectedness. What I mean by that is you have many sectors that will give you signals, you have currency markets that will give you signals, and you also have the yield and bond market that will give you signals. Combining all three of those markets as we continue to execute our swing trades will allow us to continue to profit and grow our swing trading accounts. So to date, year to date, my swing trading account is up 40%, and there's no reason why none of you could also be up 40% alongside trading capital, considering we have been completely transparent with our swing trades and our day trades, and we'll continue to keep being transparent as 2022 has been an impeccable year for us so far. Thank you all for being members. Hope all this analysis helps. Please give this video a big like down below and stay tuned for more price action tomorrow.